Good morning. Thank you, everyone, and thank you, Cambridge House, for having me. My name is Christopher Aaron, and I am passionate about finding patterns of human behavior as they exist in the financial world and in the larger world around us. And I want to share some of the patterns that are shaping up when we monitor human movement in the markets and how this will impact the resource markets going forward here. So just a real quick background on me. I did not begin my career in financial services or as an investment analyst. I actually began my career in the intelligence community for the United States. I spent 2 years working at the CIA and 3 years at the Department of Defense. And my role while overseas was as a cartographer.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
So I was a pattern mapper, specifically mapping out human movement in Afghanistan and then relaying that information to military decision leaders in the field, as they call it, so they could take appropriate action. And so I approach the markets from a slightly different perspective than you may hear in some other presentations here. I really look at human beings as being part of the larger natural world around us. And when we look at nature, all of nature moves in patterns. And so we're looking at some of these patterns here up on the slide. And this is derived from the Fibonacci ratio from the famous mathematician in Italy in the 14th century. The Fibonacci ratio, what's called sometimes the golden spiral, the golden ratio.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
And we're looking at how this ratio appears over and over again in various aspects of nature. We're talking flower patterns, we're looking at the spiraling of the galaxies, as well as in human patterns, in the human ear, et cetera, et cetera. So as hard as it may be to believe, these patterns appear over and over again in the financial markets as well. The financial markets being the sum of human nature regarding a specific asset. If there's one place that everyone has to come together regarding an asset, it is in the current price. So we can talk about a lot of fundamentals. We can talk about what's happening behind the scenes with monetary flows. We can talk about drill results, and these are all important. These are all driving the markets. But where does every single human being ultimately come together who cares about an asset? It is at the current price, So I like to boil it down and focus on price. And we look at these patterns in price, and then we go from there. Now, I can't show the types of maps that I created while overseas because they were classified and I would get in trouble if I showed them. But this is an example. And what are we looking at here at this map? This is actually what's called a heat map of New York City. And so what we're looking at is based on a study of the past, based on a study of where human beings moved in the past in New York City, where are the high probable areas that they are going to move in the future? Every projection that we make as human beings into the future must come from information derived where? From the past. You know, when we look at cycles in human behavior, seasonal patterns, what time do we wake up to go to work? What time do we interact with people? What time do we celebrate the holidays every year? These move in repeating patterns, and we can base future projections on that based on our study of the past. So we're looking here at where do people in a highest probability sense move around New York City. This is the type of map that I created, and I apply this to the financial markets to look at probabilities. We'll look at some charts in a moment of how the resource sector is going to be shaping up. We can see on the outside of the island, the red lines show where pedestrians move in a highest probability sense around Manhattan. They like to move around the rivers, and they like to move in Central Park. We can see that from the red and the orange colors. Where do pedestrians not move as much? In general, they don't walk and jog in Queens and Brooklyn. We can see that from the blue colors. So that is the type of analysis that I do. And let us now turn to looking at some of the resource markets that I believe we are all here to learn about and to invest in. We're looking at silver. Silver is one of my favorite commodities to trade. I think there's incredible long-term potential in silver. But let's look at how one of these patterns shaped up, and then we'll apply this to the present moment as it applies to the entire resource sector. So silver from 2013 through 2016 was forming this downtrend, almost 4.5-year downtrend. It had lost almost 70% of its value. Everyone was extremely bearish on silver. And what did we see shaping up here in the market was this pattern, this observation of human nature, where sellers were selling at lower and lower intervals throughout 2013, 2014, and buyers for silver were emerging at lower levels as well. But notice that the slope of the buyers, the level where the buyers would come in relative to the sellers, was relatively more aggressive. The slope was relatively more aggressive for the buyers. So this is a pattern. This is a pattern of human behavior. We call it in the financial markets and technical analysis a terminal wedge. Why is it called a wedge? Because it takes the shape of, you can imagine a wedge of cheese or something like that. And terminal because the pattern tends to break in the direction opposite of the prior movement. It tends to be an ending pattern. So if we fast forward here and look at what happened with silver over the next 6 months, indeed, the buyers overwhelmed the sellers. Silver surged about 70% from its lows. And the point for, resource investors, especially in the silver juniors or the exploration companies, a lot of the exploration companies in that 70% surge in silver, they rose 300, 500, 1,000% in 6 months. So you didn't need to time this. You did not need to pick the exact bottom for the silver market, that green shading. If you were investing in these companies anywhere in the final 12 months, let's say, of this pattern, if you just recognized this one pattern and waited for everything else and established a few positions, you were looking at several 100% gains into the first half of 2016. So this is why I did begin to publish research in late 2015 publicly, is because I was looking at patterns like this. Let's look at one more example, this exact same pattern. We're talking about the oil market. Now, fundamentally a different market, right? Liquid energy versus a store of wealth. The primary driver for industry versus something with a monetary component to it. But what do we see here again? Oil 2013 to 2016, this same pattern. Why? Human beings tend to move in repeating patterns throughout time, and we can profit from this if we align ourselves with some probabilities. So here's this terminal wedge again as oil had fallen, 70%, down from over 100 down to 27 a barrel. And what happened after this pattern broke? We can see the breakout. Oil doubled in about 6 months. Of course, a lot of the exploration companies leveraged that move completely. And if you had just sat back and waited for this pattern to form into that ending of the wedge, some nice gains to be made, and also some pain to save along the way for looking at this. Now, what is really powerful for us going forward is that the entire commodity sector, the entire CRB index that we're looking at here, that is an average of 19 different commodities, is forming this exact same pattern. Not over a 2-year time frame, but over a 12-year time frame. And the phrase, the longer the pattern, the more powerful the move, could not be more applicable here. So this terminal wedge is forming across the average of 19 different commodities, which includes liquid energy, which includes industrial metals and precious metals. And there are approximately 2 years left for this pattern to break. We're looking at that coming in here into 2019, into the beginning part of 2020. This pattern, in a highest probability sense, is going to resolve upward, and there are going to be significant opportunities across the resource sector later this year. What I anticipate is that there's going to be one more low forming for the CRB, however, and it could be painful over the short run. So I think that pattern is going to work its way down, perhaps test that 2016 low, and we're going to look at this pattern moving into that wedge shape before that nice initial surge comes. Now, one really big caveat here. A bottom, which is what we expect to be coming, does not necessitate a bull market. And here's where I think my message is going to be different from many of my colleagues here. We're looking at the same CRB, the same index, and we're going back to 1980 now, so an additional 20 years. And we can see how that same pattern formed after the 1980 high, that wedge pattern. You can see the low in green. You can see how commodities were in a 6 or 7 year bear market into the low of 1986. And then what happened? This pattern resolved upward, but it did not result in a new bull market immediately. And in fact, commodities as a net sum moved in one giant range sideways for 17 additional years until 2002, when the next bull market began, lasting into 2008, depending if you want to define it as that, as we're talking about with oil, liquid energy, or if we're talking about precious metals, which peaked in 2011. So when we look at where we are now, there was the last bull market. Where are we now? We've just seen a 12-year bear market that has about one more year left to it. Is the next bull market going to start immediately? I can't predict the future, but I can look at high probability assessments based on past movements of life for the sum of human beings that come together as resource investors, and we can say there's probably an extended basing or consolidation period that is still to come here for the commodity sector. So this is going to be either a good or a bad thing depending on how you approach the markets. I think there is a ton of opportunity here if we set our framework correctly. Just a few takeaways, then we'll look at the final point, how to navigate these markets over the few years to come. So human beings, we are part of the larger natural world. All of nature moves in these repeating, cyclical, and embedded patterns. Human beings are no different. And the markets represent the sum of human nature coming together as per a specific asset class. A major bottom is setting up in a highest probability ascent across all commodities in 2019 into the early part of 2020. If you want to pin down a date for me, I'm going to say the next 12 to 18 months, we're going to see that 12-year bottoming wedge, that terminal wedge pattern, break higher. And then the extended basing period follows. So what do we do during an extended base? What is the way to navigate markets such as this? It's not by just buying and holding, unfortunately, for most of these resource investments, because that could get very frustrating. And also companies that do not receive cash flow, they do not receive financing, if their grade is too low, they simply will not stay in business. For example, if there is a 17-year consolidation to follow, as we saw last time. The two things to focus on here going forward, grade and trade. What am I talking about? Grade of the deposit. Once again, I just hit on this. Low-grade deposits are not going to be developed in a consolidative market that lasts 5 or 10 or 15 years. They're just not going to be brought out of the ground. The second thing is to trade these price swings, okay? Now, I'm not a day trader. I don't like to sit in front of the computer and stare at the squiggly lines on the screen minute in, minute out. It doesn't make me feel good as a human being. What works for me is to look at these multi-month and multi-year patterns and to try to align myself with those patterns as they're setting up, sometimes multi-week, multi-month, or perhaps 1 to 2 year swings. And there are going to be a lot of these swings coming up over the next 5 to 10 to 15 years. So thank you very much for watching this. This is the highest probability assessment for what's going to be shaping up across all the resource markets. Of course, Unique commodities will move in different waves and patterns, but here's what we're looking at. There is a way that we can be successful in these markets if we just recognize what part of the cycle we're in. Thank you.